Here's the thing about crypto taxes that nobody talks about. Your data is probably lying to you right now, and it could cost you thousands. So last tax season, I watched a software engineer named Mike nearly have a breakdown. He imported all his crypto trades into TurboTax, and it showed he owed $47,000 in taxes. But here's the crazy part. He actually lost money that year. The problem wasn't the tax software. The problem was his data. See, Mike traded on Coinbase, Binance, and used MetaMask for DeFi. When he moved Bitcoin from Coinbase to MetaMask, then swapped it on Uniswap, the tax software saw 3 separate events. It thought he sold Bitcoin on Coinbase, magically got new Bitcoin in MetaMask with 0 cost basis, then sold that for a massive gain. Pure phantom profit. But that's not even the worst part. The worst part is that most people think better tax software will fix this. They'll switch from CoinTracker to Koinly to TaxBit, hoping the next tool will magically make sense of their messy data. It won't. And here's why. Tax software is basically just a calculator. A really expensive calculator that does crypto math. When you feed it data from your exchanges, it follows simple rules. Buy Bitcoin for $10,000, that's your cost basis. Sell Bitcoin for $12,000, that's a $2,000 gain. Simple math. But here's where it gets messy. Your Coinbase CSV shows timestamps in Pacific time. Binance uses UTC. MetaMask doesn't even track cost basis. So when you transfer assets between them, nothing matches up. The software sees your $10,000 Bitcoin purchase on Coinbase disappear. Then it sees $10,000 worth of Bitcoin appear in MetaMask with no purchase record. When you sell that Bitcoin for $12,000, it calculates a $12,000 gain instead of the real $2,000 gain. This is why people end up with tax bills that are literally impossible. The math doesn't work because the data doesn't connect. Now let me show you exactly how tax software processes your data. First, it imports your CSV files from each exchange. Each exchange formats their data differently. Coinbase might show BTC/USD, while Binance shows BTC/USDT. Same trade, different format. Second, it tries to match buy and sell orders using something called FIFO, first in, first out. It assumes the first Bitcoin you bought is the first Bitcoin you sold. But when your data is missing transfers, this matching breaks completely. Third, it calculates gains by subtracting your cost basis from your sale price. But if your cost basis is wrong because of missing data, your gains are wrong too. Fourth, it generates tax forms based on these broken calculations. Your 8949 form shows gains that never existed because the software couldn't connect your transfers properly. The whole system falls apart when your data has gaps. And here's what most people don't realize. Every exchange creates gaps on purpose. Coinbase doesn't tell you when you transfer Bitcoin out. They just show it disappearing from your account. MetaMask doesn't tell you where Bitcoin came from. They just show it appearing in your wallet. When tax software tries to connect these events, it can't. So it makes assumptions. Bad assumptions. It assumes your MetaMask Bitcoin came from nowhere. 0 cost basis. It assumes your Coinbase Bitcoin was sold for cash. Taxable event. Both assumptions are wrong, but the software doesn't know that. This gets even worse with DeFi transactions. When you provide liquidity to Uniswap, you're essentially trading your tokens for pool tokens. Tax software should treat this as a swap, but most exchanges don't export DeFi data properly, so the software sees you sending $10,000 worth of Ethereum to a random address. It thinks you sold your Ethereum for $10,000. Then it sees you receiving LP tokens worth $10,000. It thinks you bought new tokens with no cost basis. When you withdraw your liquidity for $12,000, it calculates a $12,000 gain instead of the real $2,000 gain. The pattern is always the same. Missing connections create phantom gains. Now, I've been helping crypto traders fix this mess for 3 years, and I've seen the same pattern over and over. People spend weeks trying different tax software, thinking the tool is the problem, but the tool is just doing math on broken data. Think about it like this. If you gave a calculator the wrong numbers, would you blame the calculator for the wrong answer? The real solution isn't better tax software. It's clean data that goes into the tax software. But here's where most people get stuck. They think clean data means perfect exports from exchanges. It doesn't. Exchanges will never give you perfect data because they're not tax companies. They're trading platforms. Clean data means taking those messy exports and fixing the gaps yourself. Here's what that actually looks like. You export data from Coinbase showing you bought Bitcoin for $10,000 on January 1st. You export data from MetaMask showing Bitcoin appeared on January 2nd. You manually create a transfer record connecting these events. Now when tax software processes this data, it sees the complete picture. Bitcoin bought on Coinbase. Bitcoin transferred to MetaMask. Bitcoin sold on Uniswap. Clean chain of custody. The gain calculation becomes accurate because the cost basis stays connected. But most people don't know how to create these connections. They don't know which transactions are transfers versus sales. They don't know how to handle DeFi complexity. So they either pay phantom taxes they don't owe, or they file incorrect returns and hope the IRS doesn't notice. Neither option is good. The solution is actually pretty simple, but it requires doing things in the right order. First, you export data from all your exchanges and wallets. Second, you clean and match transfers so every asset movement connects properly. Third, you categorize DeFi transactions using consistent rules. Fourth, you import this clean data into tax software. Most people skip straight to step 4 and wonder why everything breaks. When you do this process correctly, something amazing happens. Those $50,000 phantom gains disappear. Your real tax liability becomes clear, your CPA actually understands your records, and tax season goes from a nightmare to a routine task. I've seen traders save $20,000 in phantom taxes just by matching their transfers correctly. I've seen DeFi users reduce their tax bills by 60% by properly categorizing liquidity pool transactions. The software didn't change, the data changed. But here's what really matters. Clean data doesn't just fix this year's taxes. It creates a foundation for every future tax year. Once your system is set up, maintaining it takes maybe an hour per month instead of weeks during tax season. Let me give you another example of how powerful this is. Sarah was a DeFi power user. She provided liquidity on Uniswap, farmed yield on Compound, and traded on multiple DEXs. Her tax software showed she owed $85,000 in taxes on DeFi activities. But when we cleaned her data, we discovered most of those quote-unquote gains were actually token swaps and liquidity provisions. Her real tax bill was $12,000. The software wasn't wrong. The data was incomplete. We connected her wallet transactions to show the complete flow of assets. Liquidity provision became a swap, not a sale. Yield farming rewards became income at fair market value. Token swaps maintained proper cost basis. Same transactions, accurate data, $73,000 difference in taxes. This is why the IRS is starting to crack down on crypto taxes. They know most people are filing incorrect returns because their data is messy. They're sending letters asking for detailed transaction records. When you get that letter, you need to show them clean, defensible records, not CSV exports with missing transfers, not tax software reports with phantom gains. You need a complete audit trail showing exactly how you calculated every gain and loss. Here's what that audit trail looks like. Every transfer between your wallets is documented with transaction IDs and timestamps. Every DeFi interaction is categorized with supporting blockchain records. Every cost basis calculation is backed up with original purchase data. When the IRS reviews your records, they see a professional, organized system, not a mess of random CSV files. This level of organization doesn't happen by accident. It requires a systematic approach to data management. But here's the good news. Once you build this system, it works forever. Every new transaction gets processed the same way. Every tax season becomes predictable. The question isn't whether clean data matters more than tax software. The question is whether you want to keep paying taxes on money you never made, or whether you want to fix the root problem once and for all. Because here's the truth, the IRS doesn't care which tax software you used. They care whether your numbers are accurate and defensible, and accurate numbers only come from accurate data. Your choice is simple. Keep fighting with broken tools and paying phantom taxes, or invest the time to get your data right and never worry about crypto tax accuracy again. The traders who figure this out early sleep well during tax season. The ones who don't spend every April in panic mode, wondering if their returns are even close to correct. Which group do you want to be in next year?